Happy New Year. My name is Don Wilkinson, and on behalf of my fellow partners at Deloitte, and in association with the Institute of Corporate Directors, and of course, our good friends at BCN TV, welcome to the Director Series. Our topic today is preparing for those upcoming year-end audit committee meetings. Now, as I reflected on our session today, I thought about audit committees and their agendas over the last few years. And of course, it's been very busy. Just think about those new accounting standards you've had to deal with, something called IFRS. And of course, at the same time, we were dealing with the fallout from the credit crisis and all the issues, including the proliferation of regulation and the challenges of financial reporting in an economic environment which is very uncertain and very volatile. We're all trying to figure out what this so-called new normal really means. So one would have thought it's time as an audit committee member to take a breather. Well, I'm here to say that I'm the bearer of bad news. I think there still is some heavy lifting that audit committee members are going to have to do for 2014, and we're going to talk about some of that heavy lifting on our session here today. Now, take a look at the map of Canada. We're broadcasting to you live to 16 cities across the country, coast to coast, and we have a terrific turnout today. We have 1,000 registered participants. Now, as I look at the map, I think we should really color it a dark blue just to reflect the frigid weather that we are experiencing for most of Canada. So hopefully everyone's been able to make it out today. And hopefully our broadcast doesn't have any nature-driven breaks in it. Certainly there are some rolling blackouts in the Maritimes. So St. John's, I hope you're with us today. Here in Toronto, I just want to assure you we survived the ice storm. It got down to -40. We closed the airport, but the good news, we haven't called in the Army, at least as of yet. Now, let's take a look at our agenda for today. As I mentioned, it is a busy agenda for audit committees, and I can tell you we have a very full agenda for today. So we're going to start with an update from the regulators. We're going to hear from Cameron to see what's on the radar screen for the regulators. And something that's really got a lot of attention, both from regulators but also internationally, and it's just this whole issue of fraud and error. And we're going to talk a bit about how can audit committees up their game around that particular area. The next topic is something that we actually spent a fair amount of time talking about at our last year-end directors session. And that's all around quality, audit quality, reporting quality. There have been a number of developments on that front. Certainly CPAB has come out with its protocol to communicate the results of their reviews of audit firms. So we'll be hearing about that in our session today. And then, if that wasn't enough, there are some things that are not really new, but there's renewed focus on them. So I already mentioned we have the proliferation of regulation, and also, of course, now we're getting a lot of spotlights on taxation. When you think about Apple, you think about Starbucks, and of course now the whole issue of moral responsibility, social responsibility. Are you paying your fair share of taxes? So we'll be getting into that and hearing from Bill on that. Now, included in your package is a report that we did, and I'll flash that up on the screen. I know you can't read it, but it is in your handout package, and it provides our point of view on some things that we think are going to keep audit committees very busy for the upcoming 2014 year. Certainly. Most of the topics, we've got 5 of them in there, things you should be thinking about. 4 of them will be covered off today. The last one I think is very significant. We won't have time to cover it, but certainly should be on your radar screen, and that has to do with technology. Clearly, technology enables business, a lot of growth opportunities with it, but there is the flip side, which are some of the risks when you think about cybercrime and putting in place protection in terms of cybersecurity. So that is all covered up in the point of view, and I'll talk about that a little later. As always, the session will be interactive, so we're going to put you to work out there. So during the next 2 hours, we are going to pose at least 2 questions to you to get you involved in the dialogue. Also, we, as usual, leave time at the end of the session for questions and hopefully good answers to those. Please don't wait for the end of the session to jot your questions down. There are question cards. Get them to the administrator in your local setting. They, in turn, will beam it to us here in Toronto, and we'll do our best to respond at the end of the session. So, with that as the outset and the agenda, let's get moving. In my studio today, join me is a very talented and experienced group of professionals. I know my very short introductions will not do them service, so included in the handout package is some bios on each of the individuals. But to my left is Kathleen O'Neill. Now, Kathleen is a very seasoned and experienced director. She sits on a number of corporate boards and in fact is the chair of audit committees for many of those, including Finning, Cadillac Fairview, which is a big real estate operating organization, ARC Resources, and I know, Kathleen, there's many more. You sat on the board of TMX, Hydro One, active in the not-for-profit sector, St. Joseph's, what is it, Health Center, I guess it was. Mm-hmm. And before that, Kathleen was an executive in the tax area over at BMO, and prior to that, a partner with PwC. So Kathleen, welcome to the Director Series, and we're looking forward to your comments. Next to Kathleen is Bill MacKinnon, and I think many of you will recognize that name. Bill had a 40-year distinguished career at KPMG, 40 years, Bill, and the last 10 of which he served as their Chief Executive Officer. Then apparently in 2008, right during the credit crisis, he retired. Now, of course, there is no such thing as retirement. So Bill has been very active in this so-called retirement. 2010, I think, became the chair of the Canadian Institute of Chartered Accountants and busy on something called unification and the new designation of CPA. Bill's also very active on the governance front, serves on a number of boards, and he's the chair of the audit committee for things like TELUS, PSP Investments, which is a very major institutional investor, Novadak Technologies, and I know a number of others. Bill also involved in the not-for-profit sector with the likes of Toronto East General Hospital. So very, very involved, a wealth of experience, and Bill, delighted to have you on board and hear your comments today. Next to Bill is Jane Kinney, and Jane, you've been on the Director Series before, so welcome back. Jane is our Canadian Managing Partner for Quality and Risk. So what's that mean? Well, she sits at our executive table and obviously looks after things like quality and risk, but also in terms of guarding Deloitte's reputation in the Canadian marketplace. She's also been our Global Chief Risk Officer. And when you think about what's happening globally, that's quite a challenge. So very well steeped in terms of risk management. In fact, she's very active in terms of looking after our major clients in terms of governance, risk management, regulatory consulting, and internal audit. So very busy top of the house. So Jane, welcome back, and looking forward to your comments. Cameron McInnis. Now, you'll recognize Cameron's face. He has been here a couple times at least, Cameron. And of course, the chief accountant at the Ontario Securities Commission. Cameron, I think it's well over 10 years, well over a decade of experience with the Ontario Securities Commission. And for those of you on the West Coast, he's got some of those Western roots. He graduated from UBC and spent some time with the British Columbia Securities Commission. Cameron was also involved as an observer at the Enhancing Audit Quality Initiative, which we're going to be spending some time talking about today. So lots of perspectives. Welcome back, Cameron. Now, there's a last individual, Brian Hunt. Unfortunately, we ran out of chairs today, so we couldn't get Brian here, but he will be a pre-recorded interview a little later, and I'll introduce him then. So, as I mentioned, a full agenda. Let's start and look at what's on the regulator's radar screen. Cameron?
Well, thanks, Don. It's a pleasure to be here once again. It's been a busy few years for financial reporting in Canada's capital markets. Now that we have IFRS fully implemented and under our belt, we've 3 years actually of IFRS financial statements in our capital markets, and we're certainly now into our second wave of financial reporting under IFRS with a whole bunch of new standards that are effective this year. So there's no shortage of topics for all of us to think about. I want to start by saying that the views that I express are my own and not the views of the OSC or its commission. I want to start by talking about some of the areas we focused on over the past year. In my last year's remarks, I talked about two topics, impairment and segments. And we've done a lot of work in that area, and we actually issued a financial reporting bulletin on those two topics in September. I would encourage you to pick that up. And I want to briefly comment on a few aspects of those topics. Impairment of assets, that certainly has been an area we've focused on given the challenging global economic environment over the past few years, because it is important for investors to have good information about the value of assets that are reported in financial statements. There's a number of observations in that notice I mentioned. I wanted to highlight a couple. When impairment does occur and is recorded in the financial statements, IFRS does require good disclosure about some of the assumptions that go into the value of those assets. We haven't always seen good disclosure about those assumptions. For example, if the valuation is based on a discounted cash flow, what are the cash flows that it's based on? Is it next year's projected earnings? Is it 3-year projected earnings? What is it actually based on? And why? Why does management think that those are the right numbers to choose for their valuation approach? Similarly with discount rates, growth rates, and those types of things. What are the ones that are selected? And more importantly, why? Because it's important for investors to understand management's judgments in applying some of these assumptions. Now, also on the topic of impairment, IFRS does require very extensive disclosures just in general. If you look at the standard IAS 36, it has pretty much 4 pages of required disclosures for impairment. How far does one really need to go with all of those disclosures is a question that's often presented to me. And my response to that is I think materiality really does need to come into play here. Thinking about the impact on an investor's decision. That's really the focus of what materiality is all about. If you think of an example of where there's a business, an issuer, that has 2 different businesses within it, 2 different cash-generating units. One cash-generating unit has suffered impairment 3 years ago. It continued to suffer impairment. It's the past of the company. It's almost on its last legs. It's really coming to a close, and it suffers impairment in the current year. Versus a new cash-generating unit, which is the forward-looking aspect of the business. It's the future, and it suffers impairment for the first time in the current year. Now, thinking about what would impact an investor's decision, you think about those 2 different situations. Well, I would submit that it's much more important to comply very substantively with the disclosure requirements for that new forward-looking aspect of the company and the impairment that it's suffering versus sort of the old history of the company that really probably the investor already knows a lot about. So I think that's really important to think about the forward-looking aspects of a business when thinking about materiality. Segment reporting is another area that I mentioned that we've focused on. Often we've heard that investors do not have enough information about the different features of a business, and segment reporting does really achieve that if it's performed properly. One issue that we often find is that there's not enough segments identified. Sometimes we will see issuers with 1 segment. And then you look at the MD&A, and it talks about different aspects of the business of the reporting issuer. It talks about revenues being generated perhaps from media, from online, from print, different features. And sometimes it doesn't look like the story is the same between the financial report and the MD&A. And if those stories seem inconsistent, sometimes that does raise questions at the staff level. The topic of segments is a topic that does occur on both sides of the border. It's a focus of our attention, but also in the US, I know that there have been cases. One most recently comes to mind where there was an issuer that didn't segment its parts division from its trucking division, and enforcement action was actually taken in that case. So I would encourage you to be aware, if you're certainly cross-border listed issuers, that this is a topic of focus globally. Another topic related to materiality and segments is IFRS does require disclosure of revenues to foreign jurisdictions when material. And I want to underscore that issue of when material. Sometimes we don't often see that disclosure provided on the basis that perhaps the issuer believes quantitatively the revenues are not material to a foreign jurisdiction compared to domestically. However, perhaps in that situation, the foreign jurisdiction is the growth area of the entity. It's the forward-looking growth aspect, and it's exploding. Well, perhaps in the current year, it may not be quantitatively as material as the domestic operations, but qualitatively, do those growth aspects actually create a materiality point of view from an investor standpoint? And really thinking about what is important from the investor standpoint is what I'd like to underscore on this whole issue of materiality. And I think if we think about the financial statements as more of a communications tool and less of a compliance exercise, I think we can really improve the quality of financial reporting in the capital markets. And certainly thinking about materiality and the forward-looking aspects of the business are what the communications features are what I'm really talking about here. And I think audit committees play an important role here. Audit committees are sophisticated, knowledgeable individuals who have a great deal of experience. They can see the big picture. They can see this as a communications tool, as opposed to us bean counters who are preparing the financial statements, who are in the weeds of the standards trying to comply. So I think the audit committees can really take a higher level, holistic view and think about the financial statements as a communications tool to investors. Non-GAAP measures is another topic I just wanted to touch upon briefly. It's still a hot topic with us securities regulators. Recently, the OSC looked at over 50 companies on the topic of non-GAAP measures, and the results were quite disappointing. There was a staff notice issued in December on that topic. I would encourage you to pick it up. Over 80% of the companies that were looked at had to commit to improve their disclosures on a go-forward basis with respect to non-GAAP measures. So it is still a disappointing application of what staff expect. Some of the problems I'll touch upon, not explaining what the non-GAAP measure is supposed to be used for. So how do investors use this measure? What are they supposed to do with it? And not clearly explaining how the non-GAAP measure is calculated. So going to transparency is really important. I don't think companies are trying to mislead anyone by using non-GAAP measures. I think there's a purpose. Companies want to tell their own story. But it's important that when they are used, that investors have good information about what it's supposed to represent and how it's calculated. And so I would encourage you to look at staff's expectations on that topic. Lastly, just want to touch upon a few things that I'm interested in looking at currently and throughout the next year. As I mentioned, there's a whole host of new standards that we all have to contend with. Some are already in effect now. For example, the consolidation standard, IFRS 10. There's some new concepts in that standard, such as de facto control when you have less than 50% of the voting rights. I want to understand how companies are applying those factors in considering substantive control over another entity and consolidation in that regard. And another standard that's new to all of us is IFRS 13, fair value measurements. That has got some new concepts in that standard. I'm interested in understanding how those concepts are being applied. There's certainly enhanced disclosure obligations now when, for example, there's unobservable inputs going into some of the valuations. I think about the real estate sector, which is very hot in Canada right now, and the IFRS standard that deals with investment properties does have IFRS 13 connections to it. And so I'm interested in understanding how issuers are complying with some of the disclosure obligations and measurement aspects of fair value measurement in IFRS 13. So I hope some of those thoughts are helpful to you, and with that, I'll pass it back to you, Don.
So Cameron, I think a lot of things for audit committees to think about in terms of those year-end accounts and of course what the regulators are going to be focusing on. I was particularly pleased to hear about materiality. I think more forward-looking as opposed to backward-looking was part of the message. The other thing I think shouldn't be lost is materiality also applies to the extent of disclosure. So, rather than dumping everything into those financial statements, the regulators and hopefully audit committee and auditors are looking for material items, not the whole kitchen sink and so forth. So I think that application of materiality is important. And the other thing I thought was interesting was this whole non-GAAP measures. And we're gonna talk a little bit further later on. Kathleen's gonna talk a bit about that issues, but certainly my observation would be we're seeing a lot more non-GAAP disclosures in the financial statements, I think, or in other documents, certainly here in Canada, but that's also the trend in the US, and perhaps that because the accounting really, people believe, do not tell the story. So some issues around that we're going to get into. But this consolidation point, I wanted to just get your reaction to. What do you expect different in that? What are you looking at specifically?
Well, it's funny you mentioned that. I've often been frustrated as a securities regulator over the course of my career with our old Canadian standards in this area because they weren't as clear. They didn't have as much recognition of the fact that you could have control with less than 50%. And I've engaged in file issues where I truly believe the entity that had an ownership interest in another entity should consolidate that other entity, but it was below 50%, and I often felt that there was a choice to be made, and I didn't really have much say in that. Whereas now, under IFRS 10, there's much greater guidance, there's a much clearer notion of de facto control, a much greater sense of factors to consider. For example, if you have less than 50%, but all other shareholders are widely dispersed, that's now a concept that is recognized in IFRS 10. Voting patterns at shareholder meetings to vote the boards of directors in is another factor to consider. These are all things that have been on the front of my mind, even under our old standards. Now they're embedded in the new standards. And these are some concepts that I'm interested in seeing how issuers are applying.
So I want to explore just further this concept of quality financial reporting, meaningful information to stakeholders, shareholders, and so forth. And maybe Kathleen and Bill, I'm going to bring you into this, your comments as audit committee chairs and members. But you know, this idea that the standards keep coming out, the financial statements are becoming more and more complex. One would be hard pressed to call them anywhere near user friendly. But the world that we operate in is very complex. So how do you improve the quality of financial reporting? How do we make sure, you know, the story is told, but it's told in a meaningful way? And I think the audit committee and a number of players have roles in that. But maybe your thoughts on, you know, how can we improve the quality of financial reporting, the relevance of key information?
Well, thanks very much for asking the question. A challenge for us, all of us as members of an audit committee and as chairs, is that we have a broader responsibility, and to some extent we're delegated by the board often to review and recommend to the board not only the financial statements, but certainly the financial components of the MD&A and the press release. So we look at the total picture beyond the financial statements. So it's really important to, in the context of the board and the board strategy and what they set out as their objectives, that the communication of the financial information reflects that. And you're right, Don, when we get into the financial statements, there's a lot of prescriptive information in there so that we may look at it to make sure that the disclosure is clear and transparent and as much as possible says the story. But your other tools exist in the MD&A and the press release to make sure that that the information is well communicated and transparent.
Yeah, so there are other places to tell the story, and often that's where it really gets told as opposed to in the financial statements. But Bill, your thoughts and experience around this?
Well, not a great deal different than Kathleen's. I think that the use of non-GAAP measures has increased substantially over the past few years as GAAP itself has become more complicated, and I think that's going to increase more. We have a responsibility, obviously, to make sure the financial statements are issued in accordance with generally accepted accounting principles. Management has an obligation to explain it in a way they think describes how the company has done in accordance with the strategy. I think that is consistent, but I do think that we will see this grow. I'd like to see a way where the two actually were closer versus I'm concerned now they're growing further apart. And I would like to see a way where they're closer, so you have a closer relationship between the GAAP and management presentation. So that's the name I would like to see us pursue.
Your sense just on the financial reporting, you know, as the committee, is it really first let's comply? You know, we don't want to get the notices from regulators because that creates all sorts of issues, so we have to respond to that regulatory issue, and that really becomes the #1 priority as opposed to the clarity of the message in the financial statements in terms of really portraying what's happened. You get a sense there's more of that view in the audit committees that you've seen?
I don't see them as mutually exclusive. So I think clearly you have to comply with what's required by the accounting standards and by the regulators in terms of what you disclose and what you present. But then what the messaging has to be consistent with the overall strategy and what the investors and the shareholders overall are looking for in terms of results and measurement of progress relative to the strategy.
Cameron.
Yeah, if I can just add a comment too from the regulator's perspective, I think that we all have a role to play in trying to make sure that irrelevant information doesn't make its way into the financial statements. I think there's a bit of a checklist mentality that's often in play. Perhaps the auditors are contributing to that. Ourselves as the fear of the regulator, I completely agree with that and recognize that. From my perspective, though, I'm constantly told by the people that I report to, my boss, do not focus on immaterial information. And I'm trying to disseminate that message throughout events like this. And one message that I want to enforce and impress upon is that the standard actually says you do not have to provide a disclosure that's required by IFRS if it is not material. I often wonder how often that's exercised. And I think that's where audit committees and directors can really play a role in looking at the bigger picture, looking at the substance of the notes, and saying to themselves, is this really relevant, or is it just a checklist of information that's been dumped because the standard seems to require it, without thinking about that overriding principle of materiality, that you do not have to put something there that's irrelevant. And I think that could impact disclosure overload and improve the issue of disclosure overload if we focused on that a little bit more.
So that is encouraging, Cameron, to hear from the regulators. And I know you mentioned that message last year. And in fact, the regulators around the world, are aware of this. They are trying to put in place activities to make the financials more meaningful. I think that's going to be a long road for us to get there. So obviously, a lot of work to be done on that particular front. One thing I do want to bring out is something new that's taking place internationally. It's something called integrated reporting. And this is an international effort. It is mandatory in South Africa, so it's already in place there. But it's really a more, how I say, holistic way of reporting the value creation activities of an organization. And it's meant to help a broad group of stakeholders in terms of their decision making and also their capital allocation decisions. Now, the interesting thing is when I say capital allocation, it's broader than what we've typically seen. Typically we focus on financial capital, so equity, debt, and so forth. Profit, that's what we focus on in our financial reporting. The concept of capital in integrated reporting is much broader. So it goes to human capital, intellectual capital, natural capital, which just think about water or air quality, and of course social capital, which deals with impact on the community. So a much broader concept of capital and then measuring performance against that. So we're starting to hear this drive to a more holistic, long-term strategic approach, describe the business model, how do you make money, and how do you actually create or destruct value against all those measures of capital beyond just financial capital. So that's coming in place in South Africa. This panel's reaction to that direction of reporting.
Go first. I think their objectives are well-intentioned and they are getting at what people, the different readers, different stakeholders want to hear. My concern would be we already have a number of venues to communicate information. We have the financial statements, we have the press release, the MD&As, the proxy circular, the annual information form, and various other regulatory filings. It would, from my perspective, a lot of that information is probably there, so adding another report, I'm not sure is going to solve the issue of being clear and transparent and disclosure overall.
Bill, your thoughts?
I tend to agree with Kathleen. I think we need to be concerned about information overload, and we also need to know immediately what do the users of the financial statements really want to know versus what we think they want to know, and I'm not sure that this will address that. I would suspect the analysts and other institutional would go to their favorite candidates, cash flow, return on capital, those kind of things. I'm not sure this will get as much pickup as people might believe, but I could be proven wrong.
So a lot of issues to still solve on the existing model without trying to overlay some complexity on this new one. But it is getting some momentum, and I did want to bring it up so that you were aware of that happening internationally. And I know, Cameron, regulators will be monitoring this. I think that's fair to say what they're doing right now.
Well, that's right. It's certainly, who knows where this is going to go. As Bill said, it depends on what users want. If investors do want this kind of information, that will, inspire us to think about it further into the future as regulators. But right now, it's at its early stages. Interesting project, and we'll continue to monitor it. And who knows? It could be the next evolution of the next annual report. We just don't know. But it depends on what investors really want.
So it's there in South Africa. Something that I know the regulators are paying much closer attention to than integrated reporting, and that is the subject of fraud and error. And of course, locally concerns around it in each domestic economy. Internationally, you have organizations like Transparency International talking about those, coming up with policies for businesses to deal with corruption, bribery, gift giving, etc. So very much front and center. Jane, I know you spent some time looking at this. Your thoughts and comments.
Yes, recently at Deloitte we've done some research to determine what have been the major reputational risk issues that have impacted organizations in the last 10 years. And interestingly enough, at the top of the list was events related to Foreign Corrupt Practices Act. Now, this is a U.S. act, as many of you would know, but we have a Canadian equivalent, and more recently there's been a few actual convictions under that as well. And civil charges against outside directors in the face of fraud are also occurring. And what's coming through from that is that from a director standpoint, it really is not sufficient to just not know about it. Like, you need to be educated. And so that's one of the areas that audit committee members should think about in terms of the education around what would red flags look like, what should they be doing about it, and specifically looking at the fraud risks in their specific organization. The OSC is also concerned about emerging markets, and many will recall the publications that were put out last year, and obviously the aftermath of Sino-Forest. And the OSC is basically concerned about what they see as the failure of various gatekeepers, and was quite critical of directors and their roles around emerging market issuers. But the issue, of course, is really what should the audit committee be doing to safeguard their organizations from what could be potentially catastrophic reputational risk events. So oversight of fraud and risk management usually is delegated to the audit committee. And one of the first things most audit committees would be doing is inquiring of management, what are you doing in terms of preventing or detecting fraud, error, corruption. But one of the issues with that is with management override. We know that some of the most significant frauds are perpetrated by the most senior management, and those are actually the most damaging and usually the most significant by far in an organization. So having a hotline is critical. This is a requirement under regulations, including Sarbanes-Oxley. And one of the things we do know is that the frauds are often identified by tips. So that is the most frequent way frauds come to the attention of the directors. And now actually the SEC is paying for tips, and that may be a trend going forward. So having an effective hotline is critical, but one of the other leading practices I've seen around management override is to actually have a robust challenge session. So one large bank that I'm familiar with actually looks at what has happened to others and what has happened in their own organization in terms of risk issues, events, and looked at questions around it, and then having challenge sessions sort of facilitated by legal and internal audit to ask the questions around, okay, what kind of discussions did you have? How did you bring in the business? How did you make sure that the business heads aren't overriding, etc.? A good practice, I think. So there are other good practices. Fraud risk assessments, compliance programs, have been in place. But one of my points, I think, for today that I would love to have others think about and comment on is it really time for a refresh? So again, at the time of Sarbanes-Oxley, a lot of work was done around fraud risk assessments, and a lot of attention was paid by audit committees at that time.
My sense is that over time, those processes are still in place, but they've become pretty routine and perfunctory. And they're certainly, I don't think, getting the attention that they once did at the more senior levels of the organizations and at the audit committee levels.
So I just, Jane, thinking about that, Sarbanes-Oxley, of course, that came in significant changes to respond to some failures like Enron in the U.S. And we put in place all sorts of activities, compliance programs, internal control over financial reporting, enhanced the role of audit committees, internal audit, et cetera, et cetera. So a lot of effort went into this. And that was 2002, 2003. And then, of course, we had the credit crisis. So the question is, you know, is it a refresh, or do we need to relook what we do? I mean, is it really effective?
Yeah, so Don, you and I have had these conversations before in terms of the value of some of those programs, but I personally think the value was clearly there in the early days, clearly there. And you really can't expect in the world we're in as it's moving fast, like even in the terms of fraud, I mean, the types of fraud that are occurring now are way different than they were, you know, even 5 years ago with all the technological change, et cetera. So yes, I think you need to keep thinking about these things. You need to look at you know, what has happened and learn from it. So real life stories are way more engaging. So when you can actually talk about, you know, a London whale example or some of those other examples that are out there, and look at your own organizations to say, okay, do we really understand what happened there, and what could the impact be on us, and could it happen to us? Those are good sessions to have. I think they're much more engaging. They move away from the routine and they make it real. And so, you know, as a risk professional, one thing I do know is that you know, there's not a lot of attention for proactive risk management, or maybe not enough. But when things go wrong, it's amazing the attention that ends up producing, and maybe that's just human nature. But at the fundamental of all of this, or the foundation around fraud, corruption, error, risk management, is obviously a strong, effective culture. So setting the tone at the top, we all know that that is part of the responsibility of directors. And actually having a culture that rewards ethical behavior, honesty, accountability, integrity, those are all obviously essential. Having an atmosphere of zero tolerance for fraud, I think, is a no-brainer. But usually it's not the blatant situations that are concerning, but it's the gray areas, and that deserves a lot of discussion and debate. So there shouldn't be a lot of pressure on unrealistic and sort of unattainable results. That creates an environment where pressure can actually produce people to do things that they shouldn't, and those are the risk areas that really need to be focused on. I think I'll stop there, Don.
So just I want to pick up on this subject of culture. I can remember a number of years back having discussions with directors, and this would go quite some time back, and they would say, well, you know, the culture, that tone, we can do a few things at the board, but really it is the executive group that has to deal with it. So it was pushed down to management. I think now there is agreement that the board, you know, needs to be involved in setting that tone of culture. But, you know, the question is, what are they doing? And it often falls on the audit committee in terms of this area. So Bill, maybe I'll start with you and your thoughts on what is it, you know, that audit committees need to do to get at this soft subject of culture.
Well, I would actually think about boards first, Don. I think one of the most important decisions the boards make is who they hire as the CEO, and who the CEO in turn hires the CFO. Both must be competent, but both must have very high standards of personal integrity. The kind of people that will say, we don't do that, and mean it. And we'll turn down business rather than do that. So I would start there. I also think that you have to have certain awareness. I'm a worrier by nature. It's just me, and when I see some of my boards go into foreign jurisdictions, I worry. I don't know enough about those jurisdictions. I want the company to know a fair bit about them. I want to understand the business practice there. I want to understand whether, in fact, we should even be engaged in doing business in that particular organization. And you shouldn't lose sight of Canada. Canada's far from pure right at the moment, too. It's got its issues as well. So I do think the culture and the reward system are very important. I think the tone from the top is very important, but you've got to say, we're not going to do it, and we'll turn down business rather than do it, and people got to believe it.
And I think you're right, Bill. It's the CEO and the CFO, because of course the CFO has got some professional responsibilities. You need to have a CFO with a backbone. But do you think boards are doing enough to check that, to feel good around the doing the right thing? I'll put it that way.
Well, I'll be interested in what Kathleen says. I think we are doing more. I think a lot of boards have been quite concerned about recent events, both in Canada and abroad, and are becoming more concerned about it. I totally agree with Jane that when one of these events happens, it takes over a company. It just takes over a company. And the internal damage and the stress and the worry are considerable. And that's something I wouldn't want any of the organizations Canada face, and certainly not one that I'm involved with. So is it getting more focus? Is it getting more timely focus? Are we doing a better job at it? Yes. Are we as good as we need to be? Probably not.
Kathleen, your thoughts on this culture piece?
I agree totally with what everyone has said around the importance of the tone at the top and the culture and overall the philosophy of the organization of quote unquote doing the right thing at all times. The only thing I would add is it's probably also important, and maybe this is a role that the audit committee can play. It's important to be comfortable that it's permeated the organization. So you see management around the board table and you get the assurances, but if you have a large organization, in particular if it's decentralized, how do you get comfort that the sort of code of conduct, I'll call it, and the compliance programs really have life and the whistleblower is well understood? So asking those kinds of questions I think would be a really beneficial thing to do. And then the focus on refreshing your code of conduct, your compliance, making sure it's up to date, and then understanding what's actually being communicated right down to the frontline employees as to what level of expectation is there around the code of conduct and adherence to it.
Jane, your reflections.
I just wanted to comment on the compliance program globally. I think to be effective, it really needs to be country specific. So, there are lots of resources in terms of ratings around the degree of corruption in various countries, but I think an effective compliance program really needs to think about or actually respond to the different environment and culture and actual norms in various countries to be able to have the most effective processes in place.
So let me just pick up on that, because foreign operations, of course, the OSC did its review, CPAB did its review in terms of audit quality, and real concerns as you move into different jurisdictions that you don't know. You're not sure what the legal structure, political structure, except regulatory structure is, and the quality of some of the activities there. So and yet Canada, when you think about mining industry, a lot of operations overseas, how do boards, and particularly audit committees, get their hands around this issue around, and particularly around fraud and error? Bill, I'll start with you, and then Kathleen, I'll let you.
It's a very good question. As I say, whenever I see certain foreign jurisdictions, I start to worry and ask a lot of questions about the business practices, about who we have there, how competent they are, how well trained they are, how they're paid, who their loyalty is. Make sure the internal audit visits them. And two of the ones I'm involved with, internal audit goes to all the international organizations every year for a major review, and uses locals as well. Keep on asking questions about it, looking at results. Are they unusual? Why are they doing so well? Why are they doing so poorly? So we do a whole bunch of things like that, but I wouldn't kid you. You can still have problems.
And I agree with what Bill says. I mean, a couple other things that the board can do is obviously site visits and looking to their advisors, including the external auditors. How actively engaged are the external auditors in those foreign jurisdictions, and how actively engaged is the senior members of the management team, just to add to what Bill said.
Yeah, so that's important in terms of understanding the risks, the connections, and I put the boots on the ground, borrow U.S. terminology, but it is important to be there and to talk to people and understand it, as opposed to try to maneuver this long distance. Cameron, I don't know, from regulatory perspective, thoughts around this? This is
Well, sure. I mean, a lot of the points that have been discussed were highlighted in an issuer guide that we published last year for companies operating in emerging markets. So a lot of what you're saying is very consistent with what we said in that document. For example, the audit committee, the board really needs to understand the culture of the jurisdiction that they're operating in, the regulatory environment, the legal structures in terms of the corporate entities that are created for valid reasons or perhaps not so valid reasons, and certainly understanding the competence of the auditors that are in play in those foreign jurisdictions, and having regular dialogue with the auditors, more regular perhaps than what would normally be expected for an audit in a domestic situation. So a lot of those concepts that have been discussed are included in that issuer guide that we did issue about a year ago.
So it is a bit of beware, have your eyes open, make sure you have some contacts on the ground around this, and obviously external audit plays a role, management plays a role, but perhaps internal audit obviously in there, and also I think board-to-board interactions when you're looking at that. The other thing Jane, you touched on whistleblower, and that clearly is a key thing, because I think most of the frauds ultimately come through, despite all those other mechanisms, come through whistleblowers. But of course, I think when you start compensating whistleblowers like they're doing in the U.S., you need to be a little careful about some of the unintended consequences on that front. So it is something that I think boards need to be focusing, audit committees, but how do you up your game there? Certainly, as I've gone through them, auditor asks the three questions, and we get fairly perfunctory type responses. We make notes and we move on. So there's something about how do we get really at the issue around this. And it is now time to put you to work. That's that very question of how can the audit committee improve an organization's defenses against fraud and error? Time for your thinking and dialogue on that. We'll see you in 6 minutes. Welcome back. Hopefully some interesting discussion, and I hope some innovative discussion around how can audit committees up their game around this area of fraud. I like that suggestion of a management challenge. So all organizations have a fraud risk assessment, but the question is how much rigor is in it. And certainly the case that Jane referred to in terms of the management challenge involving the legal department in that exercise, my guess makes it a little more robust than it might otherwise be. The other thing interesting is a mindset. Certainly most organizations I go to look at every time there is a fraud case, they analyze it, they come back and say, no, that could never happen to us because we have the best controls. Well, in fact, it does happen. So I think you have to have that mindset that it could happen, and you do need to probe. Also, I think good to get inside view, not only the top people, but layers down below. How do you hear from that group? And something I've always talked about is outside in. So how do you get, a situation like London Well, surely that is known out in the marketplace. How do you get that information and understand that's taking place when you're up at the governance level? So let's shift gears now, and we're going to talk about enhancing audit quality and financial reporting. As I indicated last year, we did spend a considerable amount of time on that matter. Since the credit crisis, organizations internationally have been spending a lot of time. The U.S. have been looking at that. What went wrong? How could these organizations fail? And where were the auditors? So how do we, and by the way, where were the board? So how do we improve that? So there's things coming out of the U.S., the UK, and Europe. And so it was decided it was important for Canada to have a voice. So back in late 2011, the Enhancing Audit Quality initiative took place, and 3 streams. So looked at auditor independence, looked at the audit reporting model, i.e. is pass-fail, do we need to communicate more? And finally looked at what should the audit committee be doing? So with that background, there has been a lot happening, including a protocol. I sat down recently with Brian Hunt, who is the Chief Executive Officer at CPAB, and I said, what is happening with that initiative? So let's hear what Brian had to say on this matter.
This EAQ, the Enhanced Audit Quality Initiative, was outstanding in getting different folks in a room, developing a paper which we could then take and present to the rest of the world as to these are Canada's views on some of these issues. I mean, mandatory firm rotation, we rejected. We came up with a mandatory comprehensive review every 5 years. We went and presented that to the EU. We presented that to the US. I think from a Canadian perspective, we tried to influence what was going on in the world. Will we be successful? We'll have to wait and see, but at least we had a Canadian position on some of these issues.
So you touched on a couple of them, but in terms of outcomes, 2 or 3 major ones that you'd say coming out of the symposium?
I think the 2 that I think are most significant are the desire of audit committees for more information around transparency of CPAP findings. We're working on a protocol with the firms, with the profession, with ICD, the Institute of Corporate Directors, on that, to develop that. The other issue is how can we help make audit committees more effective? And I think that's an initiative where CPA Canada, again with CPAB input and ICD input, are developing tools to help the auditor or help the audit committee be more effective and more impactful in evaluating the quality of the audit, which we think is all very positive.
So this is very much a made in Canada solution, and of course, jurisdictions I mentioned around the world are busy. The U.S., the Europeans have some very strong views around how to solve this issue. How do we manage that some of the things don't wash across our borders and create unintended consequences here in Canada?
Well, Don, I think the key to that is trying to establish what our position is. And I think that's the Enhanced Audit Quality Initiative. Got, thought leaders, policymakers, as I said, the firms together, the profession, these groups, to really come up with a Canadian opinion or view on some of these issues that are being put forward. And I think we were able to go back to the Europeans, to the Americans, and say, this is what we think you should do. And I think it's been able to give us an opportunity. We may not stem the tide, but maybe we can direct the tide a little bit and be positive for Canada going forward. We'll have to wait and see.
what do you think are the key attributes or things audit committees should be looking for in terms of audit quality?
I think it's very difficult to define it. It's one of those things that I think when you see it, you know it's there. When it's not, you can spot it fairly quickly. I think the issue for an audit committee is really, have you identified with the auditors, with management, what the key audit risks are? Have you satisfied yourself through a good, robust discussion that you've mitigated those risks? And if you have, I'm here to say that 99.9% of the time you're going to get a quality audit. So I think those are the keys that you really got to look to.
Your sense in terms of the general landscape in terms of audit quality here in Canada?
You know, Don, I would say to you that we see many examples of real good quality auditing. The problem we have is we on occasion see a high percentage of audits that aren't well done. And I think there's a trend, it's a positive trend. We're seeing less and less of that, but I still think we have a ways to go.
Just shift gear a bit around audit quality. And of course, there's been recently a fair amount of talk about the reporting out from auditors. You know, the pass-fail report is not enough. Greater expectations around it, certainly south of the border, internationally, and here in Canada, we're hearing some talks about expanding the audit report. Your thoughts on that, Brian?
Well, we're very supportive of key audit matters being part of the audit report. Our biggest concern there is that these things need to be relevant. They need to be concise and key to the audit. What we're concerned about is it becomes boilerplate. We don't see the value in the going concern coming out of the European, where they would like to go. We think that will alter the expectation gap, and I really think that should the engagement partner sign along with the firm, we're not sure that that's going to really improve audit quality. So our key focus in both the IAASB and the PCAOB's proposals is around those key audit matters. We think that's very meaningful, and that can be very impactful if done properly.
I know you're busy in an outreach program talking to them. Talk a bit about that program.
Well, we've been out talking to audit committees for this past year. We will continue to outreach to audit committees. Our key purpose of that was really to discuss the EAQ, the Enhanced Audit Quality Initiative, around greater transparency of our findings around how can we move audit committees from an oversight role in terms of the auditors to evaluating the audit that has been conducted on their reporting issuer. Response has been very positive that we have met with the audit committees. They're keen to have CPA Canada, CPAB, and ICD develop a tool which would help them evaluate the auditor, and they're asking for more information from CPAB's findings. And I think doing that will be able to give audit committees an opportunity to be hopefully more effective in evaluating the auditor and move from oversight to evaluation of the auditor, and hopefully have a good discussion at the audit committee about audit quality.
So what are your expectations in terms of what you're looking for from audit committees to step it up in this area?
What we're hoping for is a very positive discussion around audit quality at the audit committee. One of the things I think when you start talking about our findings, I don't think it's just going to be about the auditor. I think you'll bring management into it. So we're hoping that we have a very active discussion at the audit committee about risks, audit risks, how they've been mitigated, the quality of the audit, the quality of even management's estimates, valuations, things of that nature. So we're hoping to change a little bit the discussion at the audit committee away from maybe routine matters to some issues around the financial statements, which we think will be very positive. Audit committees' agendas are jam-packed today. They're looking for more time, not less time. The resources are strained. We understand all that. But when you really step back and you think about the key thing that an audit committee is there to do is to make sure that the financial statements are correct and they've got a quality audit. So we think that's some of the best insurance they could get. There'll be tools to develop. There'll be more transparency of CPAB information. So I think the audit committees will be able to deal with this in a very concise, meaningful manner.
Now, the question is more transparency in terms of reporting out the results of the inspections. Can you Tell us a bit more about that, what's involved, time frame when we can expect that, because I know everyone's talking about that.
We're working our way through it. We would see that we will have a protocol in place February, March 2014. So as we start through the inspections for 2014, which would be the 2013 year ends, okay? So sometime May, June, July, we will start talking to audit committees. And what an audit committee will get if we pull the particular audit file is they will be told that CPAB has pulled the file from the auditors. They will be told which focus areas we are going to look at, because we don't look at a file cover to cover. We pick the high-risk audit areas. They will tell which focus areas we have looked at. And they will also be told if we think there's a problem in any one of those focus areas. So we may have 2 focus areas where we have no comment, and a third we have a comment. And these would be what we were deemed to be significant audit matters where we don't think enough audit work has been done to support the opinion on the financial statements. So they're very significant audit matters. So they will start to see those sometime next summer, 2014. But we would also encourage audit committees to look at our annual public report that we do, which comes out at the end of March, and look to those for areas where we talk to the firms about major issues. We would ask the audit committees to not only look if your file's been pulled and what the report would come from the auditors that CPAB has provided some information on inspection findings, but also to look at our public report and put those two together to have the discussion with your auditor in terms of things that you might want to discuss.
So there you have it from Brian Hunt in terms of the Enhancing Audit Quality Initiative, and obviously the development in terms of the protocol, in terms of sharing information on their reviews of the audit firms with audit committees. So that's coming. You heard him say March 2014 with results coming by the summer of 2014 where you would get some visibility to those results. I think the other point he made is they also put out a annual report with more generic issues that are out in the marketplace, more systemic, and also worthy of discussion at audit committees that you deal with enhancing audit quality. I will say next week the ICD is actually have a webinar on the protocol itself. So if you haven't seen that, I think it'd be worthwhile to have a look at it. And our good friend Jim Goodfellow is moderating that. So that's next week, more on the protocol. Now, we did talk about international developments and how the landscape was moving. Well, the landscape has moved, and there have been some developments over in Europe. So maybe, Jane, just an update on what we've heard very recently.
Yeah, so unfortunately, Europe didn't care about Canada's view because they've actually reached a preliminary agreement, and that agreement is for a 10-year minimum mandatory firm rotation. Member firms, member states can actually extend that if, in the case of tendering, it can be extended to 20 years, and in the case of joint audits, it can be extended to 24 years. But one of the other pieces of that, which is also quite concerning, is there's an almost complete ban on non-audit services, including specifically a ban on tax advice and most other tax services, and a 70% cap on non-audit overall. So there's a vote in February. You know, surprisingly, this has got more momentum now. I guess one of the main concerns is that if member states actually take different time periods, we may find ourselves in a very chaotic situation with rotation in different countries, you know, all at different times.
And I understand, Jane, with the various countries in the European Union, they can actually go a different way in terms of audit services to the scope, so they can go a different direction on that as well. So some flexibility, I believe.
Yeah, within a frame.
Within
yeah.
a frame. So,
yeah.
Bill, your reaction to that in terms of tax services, for instance, putting a ban on those.
It's got a lot of talk over the years, of course. A lot of regulators or other people think that it reduces audit firm independence, and it appears that Europe is going to agree with that. I can understand the theory behind it, Don, and I can understand why some people will promote it. You should also understand there will be a cost increase because the audit firms themselves will then be required to review all the tax planning done by other firms to make sure that they actually opine on that particular expense item in the P&L. So there will be additional expense which companies will presumably would have to bear. My experience when I was in the profession for all those years is I never did experience any situations where I thought our independence was impaired. Again, people don't, as I say, share that. So I think you can't fight City Hall, and this is apparently going to happen in Europe. I'm told that this is policy, and Jane would know better than I, this policy is going to get approved, is the general view. Whether it migrates to other parts of the world or not, I don't know.
And it's going to be interesting when you think about businesses, of course, being global multinationals. They're operating in the UK, they're operating in Europe, Asia Pacific, South America, and there's all different rules. I mean, if you go to South America, Brazil, they have mandatory rotation after 5 years. Then you have what's happening in the UK. So walking through that minefield is going to be extremely challenging to work through, to make sure amidst all this we deliver what we're really after, which is audit quality. That is what we're trying to achieve. Of course, in the UK, some of the activities are more about competition than their audit quality. So I think there's going to be some real interesting challenges we sort through this, and audit committees evaluated in terms of delivering audit quality. Kathleen, now I know you are on the steering committee on the Enhancing Audit Quality Initiative, so would have seen all the streams of work that and recommendations. And you're working with the ICD and I think the CPA and CPAB, right. If I got all the initials. Yeah. You're on the advisory committee on that, dealing with some of the instruments to help audit committees deal with that. Maybe I'll turn it over to you to talk about this whole issue of audit quality and reporting quality.
Thanks, Don. And what I'd like to do is I'd like to cover 3 broad areas in terms of reporting quality and expanding the discussion. First, overseeing the work of the external auditor, and what does that mean, and what are some of the things we as members of audit committees or chairs of audit committee should be looking at and discussing with our external auditors. Secondly, I'd like to talk a bit about what I'd call beyond the financial statements, because as we've already discussed, there is a reasonable number of companies who use non-GAAP measures, and what does that mean in terms of overall quality, and in terms of the role of the audit committee having some comfort. And finally, I'd just like to expand on what Brian has already talked about in terms of evaluating the auditor, really the proposals around a comprehensive review every 5 years. But really today we're living with annually we review and recommend the appointment of the external auditor, and what should we be doing as part of our annual evaluation, and some of those tools that are coming out. So first, going to overseeing the work of the external auditor. Our key responsibilities, which many of us will be very active in over the next month or two, are reviewing and recommending to the board, which has been delegated to us, the financial statements, the MD&A and press releases, and other matters that contain financial information. At the same time, we have the responsibility for overseeing the work of the external auditor. So when I look at the time frame right now, we really are focused on that, recommending the financial statements and looking forward to hearing the report from the auditors that gives us comfort with respect to being able to do that. The key areas that we should be looking at our external auditors to provide for us in terms of the quality of their work is independence, objectivity, and professional skepticism, along with how comfortable are we with the quality of the engagement team, particularly if it's a multinational, broadly diversified company, and what is the quality of the communication and the interaction with the external auditor. When we enter into our discussions, I look at it as it's an important role of the audit committee to set the tone at the top at the audit committee discussions with respect to expectations of open, candid, and direct communications between management, the external auditors, the audit committee, and where there is an internal audit group, the internal audit group. It's important that there's opportunities as you go through your discussions and your year-end discussions to clearly feel comfortable that you're getting the real goods from each of those constituents in those groups. As we provide oversight throughout the year, one of the things that we really focus on as audit committee members, all of us, is looking at the audit strategy and the plan. And when it's reviewed with us, part of that to me is part of our getting our comfort level around overall audit quality, because are we comfortable that the external auditor, for example, has a clear understanding of the business, its strategies, its KPIs, how is compensation determined, and in order to deliver an effective audit plan. This then gets reflected in the business risks and the key areas of focus. The audit committee should be prepared to discuss not only what the auditors have identified as their key areas of risk and focus, but to tie that into what they've looked at or what the board has looked at in overall risk and risk management of those risks. Once we understand that and the customization of the plan, then it gets us into the areas that we want to focus on and of the implementation of the plan with our external auditors. For example, if a company has foreign operations, we've already talked about that a couple times, what work is being planned as a part of the audit? We already do have countries where there is rotation of auditors in place, so the auditor in the local jurisdiction may not be the same auditor as you have here in Canada. So what plans are put in place? Is management sufficiently engaged, and is the external auditor clear on their requirements and the work required to be done in order to satisfy ourselves in the audit? That is usually one of our higher risk areas, and one of the areas where I think when we're talking about the quality of the work being done by the auditor, that we really need to understand the level of work. This time of year, we also get into in-depth discussions at the audit committee with respect to valuations, estimates, and judgments. And that's where having a healthy discussion with the external auditors, the internal auditors that were applicable in management is really important in order to get a sense that there is this open, candid, and diverse dialogue, so that at the end of the day, we've got all factors taken into account in concluding on the financial statements. While the auditors go through the review, another area that you may want to focus on in looking at overall audit quality is how proactive have they been, and what level of service have they provided around major transactions during the year and the accounting implications and audit implications. Whether it's the implementation of an IT system or a major acquisition, how engaged have the external auditors been in reviewing and adjusting their risk profile? When we now sit down at the end of the year and meet with our auditors, this is where we really expect overall the high level of communication with respect to what the issues are. And I think this is the opportunity for us to really get a good sense of whether the quality of the audit, the independence, the objectivity, the professional skepticism, can't say that twice, and the quality of the team that's in place. So overall, the important time of year for us to be overseeing the work of the external auditor and assessing the level of quality of their audit that they have provided us. Let me just switch for a minute, because while the auditors audit the financial statements, we go beyond the financial statements. They will read the MD&A and the press release for the financial information, but when we recommend approval as audit committee members, we're recommending as minimum the approval of the financial components of the MD&A and the press release. There are often situations when the focus of the management team and the investors, quite frankly, are on the non-GAAP measures, such as cash flow from operations or free cash flow or whatever the metric may happen to be, EBITDA or whatever. And I believe it's an important part of our role to make sure that we understand those calculations, that they're clearly set out. Cam's already talked about some of the issues that exist, that they're clearly set out in terms of how they're calculated, that they're consistent, and then they match in with what other companies in the industry are doing. And the level of involvement you want to have with respect to your external auditors reviewing that information is something that you may want to discuss, because many of us have been in the situation where the financial statements are done, they're parked, and all the discussion then switches to the non-GAAP measures in the investor discussion. So important to think about that as we get into our year-end discussions and disclosures. Finally, I'd like to conclude by discussing the responsibility of the audit committee to recommend the appointment of the auditor and how we go about doing that. As I've mentioned, independence, objectivity, the quality of the team, the quality of the communications are all factors that we should look at. And the process for doing an annual review of the auditor's performance has varied across different audit committees and firms. And I commend the CPA, the CPAB, and the ICD with their initiatives on enhancing audit quality and the guidance that they're in the process of finalizing that will assist the audit committee to be more effective in evaluating the auditor on an annual basis. And the paper that was released last January had some guidance that was provided that came out of the US, and I hope that the draft of this guidance will come out in Canada at by the end of January. But something to consider as we go through our proxy season and evaluating the work of the auditor. Finally, I'd just like to talk about the annual review extending to a comprehensive review. The concept behind the comprehensive review is that it's done every 5 years. It's the outcome is not intended to be a tendering. In fact, the outcome is to be a comprehensive review of the firm, which would be a culmination of the work that has been done by the auditors and their firm over a period of a 5-year time frame. And I think that will be an important tool for all of us to use in our audit committees in getting comfort with respect to the quality of the audit.
So Kathleen, just picking up on this process in terms of clearly the role of the audit committee to oversee the auditor, to do the evaluations. Clearly the annual ones, most companies have some sort of process in place. I would put to you, and I'll be interested in comments, typically what I've seen is that those evaluations are done by management, and then it comes to the audit committee and they ask for their views and they kind of nod their head and whatnot, but it feels more like a management evaluation. So maybe I'll get you to react to that one, and then
I think that's a really important point, because I would look at in the guidance and tools coming out would say there's really 3 components. The first component is the audit committee itself, and the chair, more particularly the chair, looking at what kinds of issues, what kinds of questions do we want to ask. But first, I think it then starts with management and get management's perspective, and then the internal auditor's perspective, if there's an internal audit group, and then the perspective of the audit committee. So I would agree that it's primarily been management driven, and part of the purpose of helping out with these tools is to provide some guidance to the audit committee as to how they would look at it.
So there is going to be a shift. It's a change in how, yes, you've done the annual assessments, you look at the team, et cetera, those kind of standards, and there are a number out there, but it's who's doing it, who's got more ownership around is part of the shift, I guess, on this thing. The other thing that people are trying to sort out is the difference between the annual review and the 5 years. You reflected generally, but I think there's still some challenges trying to figure out what is the difference? What are the key elements? What's driving it? What should we be looking for in this 5-year review versus this annual one we do every year?
Well, I think the difference really is that you've got a longer time frame. You're looking at the whole accounting firm in terms of the level of service, the overall quality of the teams that exist. And just a much broader perspective. You'll have a history and a track record of CPAB reviews. You'll have a better feel for it's a long-term versus an annual review, really, is what the difference is.
You mentioned that tough word to say, professional skepticism.
Yeah.
So
try and say that 6 times in a row.
And maybe Bill, your thoughts. So how does the audit committee really get at that? I know in our earlier discussion we said a lot of that happens behind the scenes. There is a lot of professional skepticism with management. By the time they get to the audit committee, it's behind us, and you don't see the robustness. It doesn't mean it doesn't exist. It just doesn't play out. So how do you at the audit committee kind of evaluate whether the group's been truly professionally skeptical?
Yeah. I guess the way I would look at it, Don, is there's 2 or 3 things. One is that I have, and I'm sure Kathleen does too, have contact with the senior audit partner on the engagement a lot more than just every quarter. I would talk to most of them probably at least once a month, if not more frequently. And you begin to get a sense of the individual you're dealing with, how he or she approaches problems, what issues they bring to your attention, what they're concerned about. And I have the benefit of having some expertise in this area, so I can evaluate that carefully. I also take a lot of, and this may surprise you, I take a lot of comfort from not the CFO, but I want to talk to the Vice President Controller or whoever puts the numbers together about the relationship, the questions, the focus. And I really want to find out, frankly, whether he views they're pushing him, because I want him to view they're pushing him. And I don't want to say pushing him, I mean in a professional sense. I like to know a fair bit about the manager or senior manager in the job, because at the end of the day, they do a significant bulk of the work, and the partner reviews it, but they create and run the crew in the field. So I think those things give you a pretty good sense of what you're dealing with. You also size up individuals all the time. And are they independent? Are they strong-willed? Are they professional? Would they tell you to get lost if that was in fact necessary? So that's how I look at that from a skepticism point of view. That's what behavior is what I look for.
So that's interesting and consistent with what you said earlier about the CEO and the CFO and the character of those individuals. The same thing when you think about the leading, engagement partner, as well as getting to know the team. Are they the right people? They're robust. Do they know the industry and so forth? There's been some push clearly around audit quality and oversight of the auditors, but also calls for more reporting from audit committees. So in the U.S., there's something called there's lots of calls to action these days, and this is another call to action for audit committees. A lot of governance organizations like the NACD and others have been involved with that. What they've said is, there needs to be more disclosure about what the audit committee does to fulfill its role, including overseeing the auditor, doing the bit with the engagement partner, and so forth. And then if I also go across the pond to the UK, their regulator has pushed hard in terms of more disclosures from the audit committee, how they discharge their role, and more broadly on reporting from the board. Your reactions, maybe I'll go to you first, Bill, and then Kathleen, get your thought on that in terms of more transparency and disclosure from the audit committee and how it discharges its responsibilities. Yeah,
when I first became aware of this, Don, I guess my reaction was, what now? And then I thought about it more and more, and I guess I've become progressively more and more warming towards it. Because I do think it will cause audit committees to make sure that they have carried out their mandate carefully. It may cause them to up their game a little bit, to use an expression. I somewhat go back to, I was in a different role with KPMG when CPAP was created. And they have made public company audits better. They simply have, because scrutiny is hard to self-regulate, and scrutiny always, I think, improves you the reasonable degree of scrutiny. So putting more scrutiny on audit committees to explain what they've done and why they've done it and how it affects the audit and improves it, I think on balance is not a bad thing.
Kathleen?
I'd agree with that, as long as the information that the audit committee is providing to its stakeholders is something that's relevant. You wouldn't want it ending up being a whole bunch of prescriptive things that really doesn't provide a lot of additional information or relevant information. But I do agree that more focus on disclosure is a good thing.
I want to pick up on this issue of the relationships. You have the audit committee, the external auditor, and management, the so-called three-legged stool around reporting, and of course the relationships. You want healthy tension. So audit committee's looking for healthy tension between the external auditor and management. And you probably know where I'm going on this one. Is what about that healthy tension between the board and the audit committee and management? Sometimes, I've thought that the relationship gets a little closer between management and audit committees versus external auditors. Your thoughts on that in terms of, that healthy tension on that relationship, management to the audit committee?
Well, I think it's the board delegates to the audit committee the responsibility to review an in-depth review of the financial statements and a review with the external auditors overseeing their work. So it's pretty reasonable to expect that from the board that the audit committee does the fulsome work and reports up to the board. It's important that whoever you have on your audit committee, just like any other member of the committee, is qualified and capable and meets the financial literacy tests, obviously, so that when any reporting or review is done, that they're exercising themselves that level of independence and objectivity, so that if there's any concern that management and the audit committee and the external auditor have got too close, again, that you have to have that healthy respect for the independence and the objectivity of the audit committee. Yeah.
Bill, any thoughts there?
No, I think, look, you're chairman of the audit committee, you're on the board of directors, your job is fiduciary job. Mm-hmm. Your job is not to make friends. Right. So you have to have that reasonably professional relationship with the CFO and ask the right questions and make sure you get the right answers. And I think you do that, you introduce what you describe as a healthy tension, which is professional respect. But you could get too close. I don't want to do that. Or you can be too unreasonable. I don't want to do that either. So it's a balance. Ask the right questions. Make sure you get the right answers. Make sure they're aware you're going to ask the right questions. And you're going to ask for the right answers. I think you have the healthy tension that you need.
So, Jane.
Can I add in there for a minute? Because I would say on audit quality, obviously a big part of it is the auditors, but a big part of it is also the audit committee. So I think in terms of the collective responsibility, we'd be looking to audit committee members to step up responsibilities in that area.
So let's, I'm going to shift gears because, once again, it's a full agenda. And Bill, we put up on here regulation and taxation, old ponies, new risks. I mean, these are old issues, but there's a lot more focus on them, and I dare say more work to be done by audit committees. So Bill, over to you on that subject.
Thank you, Don. I'm going to focus initially on regulation and then swing into the discussion of the current phrase, the tax morality debate that's going on. Regulation, all companies that do business in Canada face extensive regulation. And it's growing, and I would suggest to you it'll continue to grow, because every time we have a problem, regulators and others, understandably, create new regulations to try and make sure that problem gets solved and is mitigated and won't be a problem in the future. Regulation is pervasive, and you look at an organization, it's absolutely pervasive. Whether it's financial reporting, labor, safety, environmental, etc., it goes on and affects virtually all the issues within an organization. Aside from regulation, one thing a board, I think, needs to think about is there's also expectations that they have to deal with that may or may not lead to future regulations depending on how they deal with them. And I would put in this area such things as executive compensation. Fair bit of pressure and fair bit of views on that right now. Depending on how they deal with it, there may or may not be regulation. A composition of boards, I would view as similar. Relationship to communities. So I think, as well as regulation, boards need to think about the expectations and how they might deal with those going forward. Now, directors cannot have a deep knowledge of all regulatory items, and yet they have a responsibility to ensure the company is dealing with regulation on a sensible way, applying due diligence and taking care of it to the extent they can. So as directors, what do we do? And I would suggest there's a number of things you might think about. Firstly, I think the most important thing is to ensure the company has a vigorous compliance process to identify regulatory issues, analyze them, determine what their effect on the company might be, and develop processes for dealing with those regulatory items. And then laterally, ensuring that those processes, in fact, are effective. And this is going to include a whole series of organizations within the company. General Counsel's office, obviously. The regulatory office, if one exists. The business units. Internal audit plays a great role. You may or may not decide to use a third-party expertise on an as-needed basis. And more audit committees, in fact, are using third-party expertise to help them out with certain things. Senior management and the board also have a role, so there's a number of people that have a role for this regulatory compliance aspect. What can the board do specifically? I think you should take advantage of industry-specific expertise you have on the board. Every board does have some of that. Speak to those people, get their views, see what they're concerned about, try and ensure the company is dealing with those concerns on a positive basis. Use board committees appropriately. You're going to have a compensation committee, a governance committee, an audit committee. Make sure the reports are fulsome, deal with the regulatory issues, satisfy the concerns you would have. Also, as a director, you have a responsibility personally to be informed. You need to make sure you keep yourself educated. Take courses such as those offered by the ICD, law firms, accounting firms, and other institutions on current events. You're not going to be an expert, but you will have a better sense of what's going on, and that will help you in the regulatory compliance area. You also need to review all the compliance reports carefully. The status of legal issues, regulatory actions, threatened or real. It was mentioned earlier, whistleblowing reports. And these need to be reviewed frequently and at least on an annual basis. And I would suggest you, the point is to behave responsibly. Do your due diligence. And that's the best you can do. But I think all of you should expect that sooner or later in your career as a director, something's going to happen that you could not have anticipated that comes out of left field, and then you have to deal with it in a careful, responsible manner to make sure that you carried out your duties as the director. So regulation is a big item for companies, and as I said, I think it's going to just grow. I'd also like to talk about the current debate on tax morality. And this is a very interesting issue because there is a growing view amongst a number of constituents that corporations have to pay their, quote, fair share, unquote, whatever that might be. And yet, as tax professionals, we were always taught that your job was to use legal means only, to reduce tax expense to company, and there's no concept of pay your fair share. Your fair share was whatever you were required to pay legally. That is changing. A number of reasons for that. Obviously, global governments have had significant financial problems, financial crisis, and they're trying to raise money to deal with deficits and or spending to improve their economies. Corporate social responsibility is a much more relevant thing than it was years ago, and tax is seen to be part of this. You cannot underestimate the impact of social media on the corporate world today. It's amazing how much corporations are affected by social media, and that's simply going to increase. And you also have the rise of digital business models in the internet, and tax policy in place today is not necessarily developed to take care of these business models. Policy factors also affect this. Interestingly enough, over the past number of years, it's been the habit of governments to reduce corporate tax rates in their jurisdiction using indirect taxes and to a certain extent personal taxes to fill the difference. This has been to try and attract capital, because capital in turn makes investments, creates jobs, increases the wealth of that jurisdiction. But it has become a view of many that corporations are simply not paying their fair share, and they should not get these tax rates, the breaks rather, when persons do not. So there's pushback more and more from institutions and groups within society. Most tax systems attempt to tax domestic business activity, but they allow for foreign activity to be taxed preferentially to give advantage to their locally headquartered multinationals. In Canada, an obvious one would be the tax treaty with Barbados, and that's somewhat contrary to the argument of tax fairness. Business is also multinational, and taxes are country-based, and the current systems were developed many years ago, and as I said earlier, do not necessarily reflect current business models. So we have governments, G8, G20, and OECD, and many others working on projects and changes to deal with this so-called tax fairness argument. Transparency. The tax authorities now routinely share tax information, and those countries that do not are named and shamed by the OECD publicly. The most obvious example of how this is actually working effectively is Switzerland. You will recall that in the past, the Swiss maintained absolute secrecy over banks and would not disclose any information about those banks and people's deposits. Now they do. And the US and other taxing authorities have used that information to pursue tax actions against individuals all around the world. There's also tactics in place to eliminate aggressive tax planning, or what they consider aggressive tax planning, registration of tax shelters, listing transactions which do not meet the approval of tax authorities. Penalties for promoters of tax shelters have all been successfully used in trying to reduce what tax authorities consider to be, quote, aggressive tax planning, unquote. More disclosure. You have country by country reporting required for extractive industries under Dodd-Frank, and this is being adopted by the EU, Australia, and Canada. And I would suggest to you that you'll see this detailed reporting much more in place for other industries as well, other than just extractive industries. The financial industry is one obvious example. Other things they're looking at. They want to eliminate the use of hybrid mismatch arrangements which result in income not being subject to tax in any jurisdiction. This is the so-called stateless income. There was, you will recall when Apple was being subject to a review with the Senate in the United States, they were very heavily criticized for the fact they had substantial stateless income, which means income was not subject to tax anywhere. They're also reducing the use of excessive interest deductions to shift income from high-rate tax jurisdictions to low-rate tax income. A thing called the double deduction, where you get two deductions for one set of interest, is also being looked at to eliminate as well. And they're also calling out harmful tax policy in countries that have created tax policy that have no substance, i.e. to benefit themselves to the harm of other tax jurisdictions. So they're doing a lot of things like that. And you as directors, what do you suggest you should do? Well, firstly, I think it's very important you understand the tax risk appetite of the corporation that you're working with, and review the tax code of conduct, and there should be one. And you need to consider this tax risk appetite in light of reputational issues on one hand, and frankly, there is a business decision here too, because a number of companies use tax planning to reduce their tax expense and therefore increase their cash flow and earnings. So there's a push-pull between the two issues that you have to consider. You need to understand at a high level the tax planning is undertaken by the corporations and the risks inherent therein. You also need to understand at a high level the controls in place around tax planning, including what opinions or rulings are required and what level they must be. And for those non-tax practitioners in the audience, when you get a tax opinion from a tax lawyer, a tax accountant, and so forth, you get a series of degrees of assurance. And you should, in my judgment, not accept any opinion that doesn't at least have what they call a should opinion. It should work, it should be acceptable to the tax authorities. Anything less than that, I would argue, is too much risk for a company to take on. You also need to understand the current effective tax rate compared to the standard tax rate. What are the differences? Why do those differences exist? What would you say if you were questioned by the media or by shareholders or other interest groups as to why those differences exist? When I say you, I mean the corporation. How comfortable are you with those discussions and those explanations? You also have to consider all taxes paid. There's income taxes, yes, but there's employment indirect taxes, royalty taxes. When you talk about your tax payments, make sure you do speak to all taxes paid around the world. And you need to ask about the relationship the corporation has with tax authorities around the world and how they're managed. Something you may not be aware of, but Revenue Canada has gone to a risk-based tax audit process. So they'll assign a risk to each of the taxpayers in Canada. It's going to take some time, high risk, medium risk, low risk. And they're quite willing to prepare and prepared to share that with boards and audit committees. And you need to understand why that risk rating has been assigned to that company. It isn't necessarily, if you have a high risk, it may be because you're very complex, you do business all around the world, you have a lot of very complex transactions. It doesn't necessarily mean you're using aggressive tax planning, but you should be aware of the risk rating that Revenue Canada is assigning to the corporation you're involved with. The last thing that you may or may not be aware of is Revenue Canada would like to meet with audit committees and or boards to discuss tax policy and tax risk within a company. And this is something relatively new, but they've met, as my understanding, they've met with over 400 companies to date in Canada and had those conversations. I've not been privy to one, but I suspect that all of us in the audience would find that a very interesting process to go through. And I really don't know what would come out of it, but this is something Revenue Canada wishes to do. So what are you seeing? Transparency, trying to eliminate some of what they consider to be aggressive planning, more and more focus on tax shelters, more and more openness as to where taxes are being paid or not being paid. There's a whole series of processes in place to deal with this so-called tax morality issue. Some people are optimistic that as the economy improves and tax receipts improve, this might somewhat go away. I don't think so. I think this is here with us, and audit committees and boards are going to have to deal with it. So Don, that's a quick summary and regulation and this tax morality issue.
So at the outset, I did indicate that there was going to be some heavy lifting that audit committees need to do going forward. Certainly this is one area. The high profile cases. Bill, you ran through a number of key things the boards need to be doing. First is education, understanding your stance. Where do you stand in terms of that risk appetite in terms of your things? Those are going to be important discussions. We only have a few minutes, but the one thing that caught my attention was this whole thing of tax policy. And you know, as I see lots of audit material, I haven't seen a tax policy for quite some time. So thoughts on certainly if you don't have one, you should have one, but what should be in it and what should boards be thinking about in terms of tax policy?
Well, I have seen a tax policy that and it really describes tax planning the company's engaged in, what they think is appropriate tax planning, what they're not prepared to do. It also has described some areas of what I would call risk that they think is acceptable and manageable. That's the kind of thing I've seen. But I've only seen, to be honest with you, I've seen relatively few as well. I suspect there's a great number being created as we speak. I mean, I'm guessing that. Kathleen would know better being a tax professional. That's the kind of material I saw in the one I've had a chance to review.
Kathleen?
No, I'd agree with what Bill said, is you don't see that many, and then to the extent you do, they're fairly narrow in terms of what they discuss.
So I think there's clearly an action there. Make sure you have a tax policy to set out the standards, and then you can look at your tax strategies to make sure they fit within that tax policy. And I heard also risk appetite, Jane. That's also a key one, right?
That's probably actually maybe the starting point in terms of the tax risk appetite and what is the philosophy around around taking risk. And as you said, Bill, like what will you do, what won't you do, and actually articulating that. Not easy to do.
So I did say we had a heavy agenda today. I've slipped a little as the timekeeper, so I'm going to get you back to work. We have a discussion question, which is, what is the most effective way for audit committees to enhance audit and reporting quality? And we give you three choices. A, put the right people on the audit committee. B, ensure a healthy tension between the audit committee management and the external auditor. And finally, C, oversight and independence of internal control functions. Talk about that. We'll be back in 6 minutes. Welcome back. Hopefully, once again, a very engaged discussion around what do audit committees do to improve the quality of audit and overall financial reporting. And we had a little poll here amongst our panelists, and we actually thought maybe all of the above, A, B, and C, would be helpful on that front. But hopefully, a good discussion around that. At the outset, I did talk about a point of view that we put out. Maybe we just flip up that picture on the screen a bit. No, maybe we're not having that on the screen. No, the picture with the tree. Okay, there we go. We found the tree, and the only reason I put that up there because it's an unusual image when you look at it. But it is a tough times for audit committees, but there are some green leaves on that. So it is sprouting in terms of paying some benefit. But in the publication, we do talk about 5 areas. If we can just flip to that slide next. And we have 5 areas that are brought out in that. As I mentioned at the outset, we've touched on 4 of those. Protecting brand and reputation goes to the fraud and error. Investor confidence is about audit quality, reporting quality, improving financial reporting. One of the messages I did talk about integrated reporting. I think my panelists said we got enough to deal with right now. Let's not make it overly complex. But I think there is some merit to keep your eyes on this reporting in the future. And of course, Bill talked about the concept of paying a fair share of tax. I think the one piece we didn't spend much time on was technology, and there's no doubt in my mind that that is going to be a very significant thing for you as audit committee members to spend some time on. There's no doubt that technology is enabling the way you do business. It's transforming the way you do business. So lots of opportunities to move cross-border, and apparently right now not attract taxation. But don't underestimate social media. That can be a positive, and that could be a negative in terms of picking up on things. And of course, we're talking about the movement to the clouds that once again provides opportunities, but also a number of risks. So do have a look at that point. It does talk about the issues around the downside, cybercrime and cyber security. So with that, now let me move to the questions that we've gotten. This one comes from Vancouver. So Kathleen, I'm gonna send this over to you. But the question is, how active should the audit committee be in hiring a new CFO?
Thanks, Don. My simple answer would be very active. It's a major decision of the company in hiring the new CFO, and as Bill talked about, both the CEO and the CFO set a lot of the tone for the organization. It is an important role, certainly in the organization, and particularly for the audit committee. So my answer is that the audit committee should be very active in hiring the new CEO. They should review the candidates, interview certainly the final candidate, and be comfortable that that person is the person that they want as the CFO.
And we did touch on the importance of the CFO in terms of the backbone, of course, right, when you get into issues of fraud and error. So very important to have that and that important relationship with the audit committee. Now let's Montreal. So Jane, I think I'll send this your way. If there has been a fraud, what steps should be taken to address this to save the reputation of the organization or company, and by whom? Management or the board?
Well, I guess it depends in terms of where the alleged fraud is aimed at. So obviously it's the responsibility of directors to monitor investigations into alleged fraud. But if those allegations involve senior management, that is a different story. I think in those cases, what we've normally seen happen is boards will strike independent committees. They will engage outside legal counsel and outside advisors, and that's probably an important piece in terms of driving that, depending on who is who's actually involved in the allegations.
So that's having to deal with fraud. Here, Cameron, heads up on this, it's coming over to you, something from Quebec City. You can turn a non-GAAP measure into a GAAP measure using subtotals in your income statement. I guess that's a question statement. Have you seen problems with this possibility or behavior?
Right, so the question's not exactly quite right. You can't really turn a non-GAAP measure into a GAAP measure, but I see where the person's coming from. IFRS does permit subtotals in the statement of comprehensive income when relevant to an understanding of the operations. So you can insert subtotals. We actually call those additional GAAP measures in our staff guidance. We don't refer to those as non-GAAP measures. So they are permissible and sometimes required by IFRS to insert those subtotals when relevant. We have guidance as to how to do that when you do insert subtotals. We expect there to be appropriate labeling. We expect there to not be confusion when those subtotals are used. For example, in our guidance, we talk about the term income before the undernoted. Not really meaningful to an investor if the undernoted has pension costs, restructuring costs, other things that just don't really amount to anything meaningful. So the subtotal income before the undernoted doesn't really describe what that subtotal is supposed to represent. So have we seen problems? Yes. And the results of those 50 companies that we looked at, we talk about the additional GAAP measures and some of the concerns we have with the labeling of the subtotals. So you can't really turn a non-GAAP into a GAAP measure, but you are permitted to have subtotals when relevant to an understanding.
So this was a bit of a follow-up on the Quebec City question, and of course we talked about non-GAAP measures quite a bit today and the importance of it. And I think, Kathleen, you'd commented, well, maybe the auditors are looking at that. But what's your sense, and this may be for any of the panelists, the sense of how much scrutiny is really given to those non-audit measures? Yes, you read them, and there's EBITDA and adjusted EBITDA, adjusted earnings. Kathleen, you talked about in the MD&A, there's some adjustments. I would suggest even further when you go to the CDNA, which is the compensation discussion and analysis, there's even further adjustments to those non-GAAP adjustments, often described as one-off, non-recurring, though they tend to reoccur, occasionally out there. So, your thoughts on getting comfort around those? Is there enough around it? Yes, you look at those, but you're getting enough comfort on those numbers. Maybe Kathleen, I'll let you to respond to that one.
I think there's two issues. The first issue is it an appropriate measure? And is that measure, and that's a board question and an audit committee question, is it an appropriate measure, and is it measured consistently and in a transparent fashion? Depending on your discussion there, then the second question is the calculation accurate? And in some cases, the calculation is a direct derivation from the financial statement, so it's easy to figure out that calculation. If it's not an obvious calculation, or if there's more scrutiny required, then I think it's an important question the board and the audit committee needs to ask is how much work has been done on that measure, and then how much work do you want done to make sure you're comfortable with this important disclosure item.
So I think that is an important one because internal control of financial reporting covers those items but doesn't cover that. So what are the controls and the checks around that? Now we're off to Montreal. Bill, I'm sending this to you. What about the notes of the financial statements as part of making the statements more user-friendly? Any suggestions on that front?
Yeah, I mean, whoever sent the question was a person ahead of their time, because there is an international project at work looking at just that. As I understand it, looking at things that making the notes less complex, perhaps changing the order so the more important notes are at the front versus later in the grouping of notes, having more basic language used to describe them. So I think this is a view shared by all, that the notes need to be less complex and perhaps fewer. We have lots of financial statements now that go 100 pages. And if there's a way to make that less complex and less cumbersome, that would be, I think, useful.
Yeah, I think that would be a very positive development. This one comes from out west, and it's about the audit reporting model. We referred to it. Brian did. He said he likes the key audit activities focus. He liked that piece. Unintended consequences around going concern. But very quickly, your thoughts on extending the audit committee report. Right now, it's pass-fail. There's talking about extending it. If you go to Vodafone PLC, they've got this extended audit report. Sort of in 30 seconds or less. I'm going to Kathleen, your reaction to it?
I think if it's useful, if the information that's going to provide it doesn't come prescriptive, I think it's a very useful piece of information.
Bill, your 30 seconds?
Ditto
Ditto?
with Kathleen, yep.
So you're okay with,
I just think there's a very real danger it could become rote.
so boilerplate, so not really enhancing the
Because in
view.
spite of what people say, I think audit firms
Yeah.
will be very reluctant not to say anything.
Cameron?
I think investors want more information about the audit. I think they want information when there's a close to the line call, a difficult, contentious issue. I worry a little bit about this proposal because it seems to suggest that there should always be a key audit matter discussed in the audit report. And what if it's just a boring audit? What if there's
you know
nothing
what?
exciting to talk about? And I worry that auditors will be forced to dump information into the audit report. If you look at the example audit report, it's 4
Cameron,
pages.
I've got 10 seconds, so I've got that out. That concludes our session because I need to end sharply at 1 o'clock. I hope you enjoyed us. Give us feedback. April 10th, the next session. Bye for now.